How do you look at the bond markets right now with effectively 5% yields on the Treasury curve?
Yeah, so look, I think that corporates, particularly in the US, the high-grade corporates are a bit stretched. Spreads are very, very tight there, and there's not a lot of wiggle room. But if you look a bit further than that, as I said, high yield in the US, and then if you come across to Asia, both the investment grade and high yield, I think, offer very interesting opportunities. Yields are pretty high. There's no real fundamental reason for that to be the case. We're not expecting, for example, default rates to increase materially in Asia. We're not expecting any big surprises in terms of inflation or central bank action across Asia. So I think there's great opportunities there. And as you both know very well, we've got the Indian bond market coming into focus increasingly with the addition into the benchmark indices, and that's a new area for a lot of investors. So there's a lot to play for. There's a lot to do if you look a bit further afield.
That's right. I was just talking to HSBC Asset Management yesterday, and they're expecting, I think, $100 billion of flows into that market in India, Bill. I was going to talk to you more about your talk about the Asia credit space and the opportunities maybe in bond markets there. Are you adding duration in this area right now?
I think selectively our fixed income teams are doing that. And I think you can afford in this environment to be patient and to wait for opportunities, to wait for blips, maybe like the one we're going to have now and today. So I don't think there's any big rush to do that. But yes, I think selectively that's something that our teams are looking to do.
Bill, the temptation to go back into cash, just your thoughts and your advice around that.
Well, that's been one of the sort of main plays that investors have had. There's a lot of cash sitting on the sidelines. You know, when you can get 4.5% to 5.5% on your dollar deposits, if you go out, you know, 3, 4, 5 months, that's very tempting for a lot of investors, particularly in such an uncertain environment. But that cash that's sitting there is also the dry powder, the kindling that might get markets going rather well. And particularly in China, we saw bank deposits hit all-time highs about this time last year, and they've stayed more or less there. So there's a lot of dry powder if and when the growth dynamic comes back into play, and people look more towards that than worrying about the slowdown and worrying about what's going to happen when the Fed has to cut rates.
Bill, you mentioned at the top the focus has been too much on the Fed, and we need to look at the economy. Let me use that prism and look at the Chinese market and the valuations on offer in this greater Chinese equity market and the state of the economy and also the policy push that's taking place there. Are you getting a sense that people are warming up to more exposure to this Chinese equity market, Bill?
Yeah, David, that's a great point. I think that certainly in terms of sentiment, the negative sentiment that we've had towards the Chinese economy from international investors, that seems to be bottoming out. I think that investors are now beginning to look at China a little bit more objectively, with a little bit more of a positive slant. And I think there are many opportunities. We see growth edging up. We see quite strong earnings being delivered by a lot of companies in China. And we see very, very cheap valuations across many sectors. So there are a lot of opportunities. Again, once investors decide to come back into the fray in China, I think we could see some quite interesting moves.